So look at this question. Ponty Limited. They gave us the budget. Like you see, all of this is the budget. Yeah, they gave us that budget. Likewise, they gave us the budget units. So the output and unit 500 unit, that's the budget. However, they've told us that the actual production is actually 600 units. So you have to take note of that because that's the actual activity level. Because when it's time to flex the budget, that is what you will use to flex the budget. Right. Then the actual cost and revenue were also given. Right. The actual material cost, labor cost, overhead, fixed cost, and sales revenue. And we're asked to calculate all the possible variances. We will do the first four that we have touched on today, but we'll leave the sales revenue variance for tomorrow when we've done that part. So I'm not going to touch sales revenue variance today. It's easy, but because of time, I don't think we can cover it. So let's start with material variance. Overall material variance quickly. Let's do it together. Overall material variance, what would that be? Remember, it's about what we incurred on material versus what we should have incurred on material. So let's do that quickly. What do you have? First of all, how much did we incur? So which means actual. That is 6,700. So we incurred 6,700. But the next question is, how much should we have incurred? Standard cost is your flex budget, like I always tell you. Which means you are doing budgeting at the actual activity level. Yeah. So what should we have incurred? We should have incurred materials on 600 units. Yeah. And we know that every unit will consume 2 liters. So multiply by 2 liters. It means that we should have actually consumed 1,200 liters. Right? That's our flex budget. And at our budget price of how much? $5. And that's 6,000. And that's why our actual cost minus standard cost of material is equals to 6,700 minus 6,000. And this is equals to 700. Is this favorable or adverse?
Adverse, right?
Adverse. Do we all agree it's adverse? Good. Adverse. Because we spent more than we should have spent. So that's 700 adverse. So that's the overall material variance. However, we need to analyze it into the components. Because most times the question might not ask you to calculate the overall variance. They will probably ask you to calculate price variance and usage variance. Right. And we said price is about answering this question of, did we pay a different price than we plan to pay for the actual material quantity consumed? Did we pay more than we planned for the actual material quantity we consumed? So what is the actual material quantity that we consumed? How many liters did we consume?
1,250.
Exactly. So we consume 1,250. But the question is, did we pay more than we should have paid? Yeah. So if we consume 1,250, that is the actual quantity that we consume. But what did we pay? What is the price that we paid? Calculator, that's 6,700 divided by 1,250. 5.36. That was the price we paid minus what we plan to pay, $5. So that's minus 5 multiplied by 1,250. It means that we have a variance of 450. Is this adverse or favorable?
Adverse.
Adverse. Because we paid more than we planned to pay for the quantity that we consumed. Then usage is about the quantity we consumed versus what we should have consumed. How much did we consume? 1,250. What should we have consumed? We already calculated that earlier on. We should have consumed 1,200, right? So we should have consumed 1,200 for that activity level. And we always have to value our standard price. So multiply by 5. And what is that? That is 50 times 5, and that's 250. Likewise, again, adverse because we consumed more than we should have consumed. And you will see that if you add these two variances together, what do you have? You're going to have 700 adverse, which reconciles perfectly to your total material variance. You can be asked to also probably come up with possible reasons why there will be variances in material. Yeah, let's look at usage first. Yeah, 1,200 versus actual 1,250. Why are we consuming more? What are the possibilities why we're consuming more?
There could have been some wastage, like
Fantastic. There could have been wastage. And this wastage is tied to labor skills. Because if you have a staff that doesn't know what it's doing, they're just wasting your materials. Fantastic. What else can make material consumption to be different from what we planned?
The quality.
Exactly. Spot on. We said this in the beginning of the class. Quality as well. If you are working with fake materials, you will have a lot of wastage. And the obvious one is what? Theft. You can be buying it and people are stealing it. Yeah. And for price, what are the possible reasons for price? What could make the price be different from plan?
An increase in the prices outside.
Exactly. Inflation can make as increase in price. Basic inflation can be responsible. Yeah, those are external factors. Or the quality of the material as well. You can go for fake materials, cheap materials to be cheaper. Or you can go for high-end, high-quality materials to be more expensive. Okay? So with that, with material variance, let's look at labor. And for labor, we said overall is about, did we incur more than we should have incurred on labor? So actual labor cost that we incur was 6,100. The standard labor cost, which is the amount we should have incurred.
So 7,200.
7,200.
7,200. And how did you get 7,200? Because we produce 600 unit actual, and we know that for every unit, you will consume 2 hours. So that's times 2. So this is total number of hours that we should have consumed as a labor, and we value it at our $6 rate. And that's how you got it, 7,200. Fantastic. So you are waking up now. I'm happy. So which means our variance, labor variance, will be equals to 6,100 minus 7,200. And that will give us, what is that difference?
1,100.
1,100.
1,100.
Adverse or favorable?
Favorable. Actually, it's less.
Yeah, so it's favorable because the actual is less than what it should have been. So we've actually spent less than we should have spent on labor, and that is good. That's why it's favorable. Now let's do the analysis, which is the most important, and that is splitting it into the rate variance and efficiency variance. And rate is about, did we pay more than we planned for the actual number of hours worked? Did we pay more than we planned for the actual number of hours worked? So what rate did we pay? We pay 6,100 divided by 1,100. What is that? Let's see. And that's 5 points. So we paid 5.4, 5.5 actually. We paid 5.54. But we plan to pay $6 for the actual hours worked. And what is that? Minus 6 multiplied by 1,100. That's 500. This 500 favorable or adverse? Huh?
Favorable.
Favorable, because the rate is cheaper than we planned to. Efficiency is about how much hours we consume. Did we consume more than we should have consumed? The number of hours we consumed is 1,100 minus what we should have consumed. We said we should have consumed 600 times 2, 1,200. And valuation at standard price, which is standard rates of $6. So that gives us 1,100 minus 1,200, that's 100, and that is 600. And because number of hours we consumed is less than what we should have consumed, that is also favorable. And when you add the 500 and 600 favorable, you have your 1,100 total labor variance that you have. But like we did for materials, let's do for labor as well. Why? What are those issues? Why are we having different labor consumption or different labor price? Yeah. Why? What are the possible reasons why the rates might be different? Labor skill might be different. So let's say labor quality. Yeah. Because if you're looking for some people with special certifications, they're going to definitely charge you different rates. Right. What else? There might be wage inflation as well. If there's just scarcity of labor, the same labor will just become expensive because there's scarcity. Or maybe there's overtime, or you decide to give bonuses. That will impact on your labor rate. And in terms of efficiency, what could make you spend more time than you plan to spend or less than you plan to spend? Yeah, labor skill will play a big role here as well. Because if you have someone that is highly skilled, it's going to be more efficient. It's like someone employing me as a reconciliation accountant or as account payable officer or as, something that you expect me to do in 8 hours, maybe in 1 hour, I'm done with it. I moved on with something else. So the quality of staff will impact on efficiency for sure. Likewise, motivation. When staff are very motivated, definitely they will give their best and they will focus. Yeah. And honestly, material quality as well can impact on efficiency. Like you imagine, if you are working with fake materials, poor materials, you might have to redo the same thing all over again because the first one you have done has gone bad because you are working with fake materials, poor quality materials. And that's it with labor variance. Now let's look at variable overheads. You can see the way we're just cleaning it quick. It's not more than that. Once you have that understanding, variance is easy, and it's not more than that I've seen. So what did we say about variable overhead? We said it's just like labor cost, which means let's do the actual versus standard first, just like we did for labor to get the overall. So what's our actual variable overhead? We're given actual variable overhead to be 4,500. What are our standard variable overheads? Which means we need to now do the variable overheads using the actual activity level, which should now be the labor hours, 1,100 hours. What should that be?
So 4,800.
4,800. So our standard will be based on the 600 units, which is the activity level, right? 600 units, we expect to spend 2 hours per unit. That's 1,200 multiplied by the standard rate for variable overhead, which is $4. Fantastic. And that will give us 4,800. So which means our variance will be equals to 300. Favorable or adverse? Favorable. Yeah, because the actual is actually less than what it should have been at activity level of 600 units. So always when you are going standard, always make sure that you are using your units to break it down. Activity level is your units, number of units. Yeah. Now, so we have to analyze it into 2 categories like we've done for the others. So the first one will be on efficiency. And the other one, we call it, I think, expenditure, which is like the rate variance. Yeah. For efficiency, what did we say? It's about hours. Anytime you hear efficiency, it's about hours. Yeah. Which is, did we spend more hours than we should have spent? And you value it at standard rate. So actual hours that we spent was what? 1,100. How many hours should we have spent? That is 600 units at 2 hours per unit. And that's 1,200. And we're going to value at $4 rate. And that will give us 400. So the actual is 1,100, but we should have spent 1,200. So that is favorable because we spent less amount of hours. Making sense? And expenditure, probably the easiest one, which is about the rate, about the price. Did we pay more than the plan for the actual number of hours worked, for the actual number of activity? Did we pay more? So how much did we pay? What's our variable rate? That's 4,500 over 1,100. So let's say 4,500 over 1,100. That will give us the actual rate that we paid minus the plan, which is $4, what we should have paid for the hours they worked. So multiply by 1,100. And what is that quickly? Please get a calculator, do it for me. And that's 100. Yeah. Remember, this is 4.09. So if it's 4.09 minus 4, it means that the rate is actually more than, excuse me, than the planned rate. And that is adverse. So you see that if you have 400 favorable, 100 adverse, it gives you net of 300 favorable. So it has to reconcile. If it does not reconcile, something is missing. Why, just like others, why do we have different amount of overheads? Why? This one is not like the others that you say quality of labor. Remember, it's overheads. Yeah, it's not like it's a labor, it's material. So this one, I would say, it just depends on the nature of the overheads. Because variable overhead can be anything. Yeah, it might be even depreciation on fixed assets or machine that you're using in the production place, right? It might be repairs and maintenance. The last one is the fixed cost, which is the only one that is slightly different, like I always say, fixed cost variance. Now, the overall variance is the first one, like we've been doing for the other ones, because I need you to understand overall and be able to see how it reconciles to the component. So tell me, what is the overall variance for fixed cost? Remember what I said? This is the point where you need to calculate whether there is an over or under absorption. That's all you have to check here. Is there under or over absorption? And for you to do that, you need to know your actual fixed cost. What's our actual fixed cost? It's a 5,350. So we have actual fixed cost of 5,350. What we need now is a standard fixed cost, which is our fixed cost absorbed. That is what we need. Remember, we said absorption is always equals to your overhead absorption rate multiplied by the activity, the actual activity. Yeah, and the actual activity here is $600. Sorry, 600 units. Yeah, activity level for fixed cost. Remember, it's going to be based on the actual units that we produce. So if we produce 600 units and our rate is fixed cost overhead rate is 2 hours at $5. So this 600 units, we're expected to be equivalent to times 2 hours, and that to be equals to 1,200 hours. The overall absorption rate of $5. So which means the standard fixed cost or fixed cost absorbed is actually equals to 6,000. And what is the difference? 650. Is this over absorption or under absorption?
Over.
Yeah. And once you over absorbed, that is favorable. So there's over absorption of 650. And that's a favorable variance because you've posted too much expenses. And to correct that, you have to put a credit in P&L. That's a way to remember it without confusion. Now we need to analyze it. Remember, there's two-stage analysis for fixed cost. There's a part where you separate volume and expenditure. Then you now separate volume into efficiency and capacity. So let's do the first stage, which is expenditure. And volume. And expenditure variance is the easiest variance ever made. If that for fixed cost, the expenditure variance is the easiest variance because it's just actual minus budget. It's the first time you'll be seeing budget being used. I mean budget amount. And in that case, the actual is 5,350 and budget is $10 per unit, and the budgeted unit is 500. Remember everything in budget. So 10 times 500, that's 5,000. Because it's budget, that's the budget fixed cost. And that gives us 350. And this has to be adverse because the actual is more than the budget. That's the expenditure variance for fixed cost. It's the easiest variance ever. Now let's look at the volume. For volume, we said is about overhead absorption compared with the budget fixed cost. Remember? So, which means we need to compare our standard overhead versus budget. And we already know the standard overhead is 6,000 here. And budget is 5,000. So this is standard, this is budget. So which means we have total of 1,000. Let me ask, is this favorable or adverse? Because if the standard is 6,000, means that what we absorb is 6,000. But what we should have absorbed is 5,000. So we have over absorbed. And when we over absorbed, we need to correct by putting a credit in P&L. So that also makes it over absorption, and that is favorable. Fantastic. And I like that. And look at it. 350 adverse, 1,000 favorable. It reconciles perfectly to 650 favorable. And the last thing we'll do today is to break the volume into its own components. The first component is efficiency. And the second component is capacity. Yeah. So remember, we're comparing standard and budget up there. So which I always told you, just put the standard here, put the budget here, and know that versus actual, versus actual. Yeah. So, and this is about the hours because we're talking about volume variance. So capacity in hours, efficiency in hours. By now, you know, anytime you hear efficiency about hours, likewise, capacity also is about hours. Yeah, that's what we're looking at. So which means we need to know the actual hours versus standard hours. Yeah. And likewise, the budget hours versus actual hours. So the actual hours, we have it as 1,100. The standard hours, we got that to be 1,200 here, remember? And we always say valuation is at standard rate. So what is standard fixed overhead rate? That's $5. It's here. That's the standard rate. So at $5, and that will give us 500. That's 100 times 5. Favorable or adverse? Number of hours actual versus what we should have spent. So this has to be favorable because we spent actual of 1,100 versus 1,200 that we should have spent. And likewise, we do the same thing here, actual and budget. The actual is 1,100 hours and the budgeted hours was what? We budgeted how many hours? 500 units at 2. Yeah, so that's 500 times 2. That's budget. So that's 1,000 hours. And we're also going to value it at standard rates of $5. This. And that will also give us 100 times 5, which is 500 favorable. Can you guys see what I was talking about here? About the capacity. You can see that for the capacity, actual hours is actually more than the budget hours. But we say it's favorable because for capacity, the more the capacity we have, the better we have. So we are happy to have an actual capacity that is more than our budget because it means that we can deliver more. That's why it's called capacity, right? And see, the 500 variable, another 500 favorable reconcile perfectly to your 1,000 favorable here. And that is it for today. Right on time.